Hey everyone, my name is Nolan, and in today's video, I'll be sharing with you my top 3 tips for when it's time to sell a stock. I'll be breaking down some of my biggest sales from this year, and even going through my logic and reasoning for why I did these things. Let's go. I want to set a disclaimer for this video. These companies I'm going to mention might work for you or other people out there, however they weren't reflective of my goals for my portfolio. I have nothing but respect for these companies. However, this is just my opinion, and these are my insights for why I decided to sell these companies. Viewer discretion is advised. First up, we have tip number 1. The stock hit your fair value price target. When I first started investing, I watched a video by a YouTuber named Joseph Hogue. In that video, he advised, when you buy stocks, pick a price that you think is a fair value of that stock, and when that price increases to that amount, sell. Same thing on the other end of the spectrum. If a stock price loses value and hits the maximum in which you're willing to lose money, sell as well so you minimize your losses. This year, I used this tip to sell ticker symbol NVDA or NVIDIA Corporation. Despite my evaluation of the fair value price target, I do admit I regret selling the stock at the point that I did. However, I am still pretty happy that I was able to earn 160% of my original investment.
I can smell the copium.
Back in October of 2022, I bought NVIDIA for $134. As previously shown, this year, I sold NVIDIA for $348. My target price point was $300. I earned 160% on my investment, and on top of that, I bagged $214. So whenever you buy a stock, make sure you set your high price point and your low price point so you can maximize your gains or minimize your losses based on your risk tolerance. Reason number 2, dividend cut and dividend reduction. This goes out to all the homies out there who love dividend stocks as much as I do. I used to be a dividend yield investor, and what that means is I used to prioritize income over long-term growth of a stock. Now, if you're like me and you'd like to maximize on your investments, I've learned this is not the way to do that. The problem with thinking like this is that companies who have extremely high dividend yields don't have the longevity to keep paying out these extremely high dividends, or in the future, they don't have the possibility of increasing these dividends. An example of this is Ares Capital Corporation or Armor Residential REIT. ARR has a dividend yield right now of 28.88%. The reason why I sold this company is because I wanted companies that were going to keep increasing their dividends year over year. When I first bought ARR, their dividend was 10 cents per share per month. When I sold earlier this year, ARR's dividend had decreased by 20% to 8 cents per share. To make matters worse, earlier this year, ARR did a 1-for-5 reverse stock split. This signals to me that the company is going downhill. When I sold later this year, I ended up losing $63. On the other hand, ARCC has a dividend yield of 9.87%. While I'll admit that ARCC doesn't have the most consistent dividend increases, I was super happy in December of last year when their dividend increased to 51 cents. That happiness was short-lived because shortly after they cut their dividend back down to 48 cents per share, and they have been paying that amount ever since then. Finally, let's end in tip number 3, value traps. When I first started investing, I bought a bunch of random dividend stocks simply because they had consistent dividends, and I never really considered the long-term growth of a stock. When September of 2023 earnings first came out, their net income was negative $8 million. This is down 154% from the previous year, and in my opinion, as an investor, this isn't something I really like to see. While I'll admit DLX has a very consistent dividend at 30 cents per quarter, I noticed that I bought the share price at $32 and now it's currently sitting at $16, which is a 50% loss in my money. Most people will say that share price isn't a good indication of when to sell a stock. I would completely agree, except for the fact that their earnings are a complete 180 of what they were last year. In my opinion, this is just a signal of what's to come. While I achieved my goal of having a consistent dividend, I soon realized that gaining $1.20 per year and also losing $16 per share was not a good deal to be in. Assuming the stock price stayed the same, I would have to wait 13 years to break even. Companies that pay dividends consistently with negative earnings are not sustainable in the long term. Thus, this is the final reason and why I decided to sell before I lose any more money. In my previous tip, I brought up a ticker symbol ARR. And this also applies to my third tip, because when I first bought the stock, it was nearing $8. And like I said previously, when I sold the stock, I was at a net loss of $63. To prove my point further, looking at their financials wasn't much better, because in September 2023, their earnings report showed that their revenue was at negative $168 million and their net income was at negative $179 million. This personally isn't numbers I like to see, and on top of the dividend cuts, I was forced to sell. That's going to wrap it up for today's video. Today we evaluated 3 different tips for why you should sell stocks in 2023. If you're bullish on any of these stocks, please let me know in the comment section below. I'm still learning, and I'd really like to know your thoughts. Thank you, and peace out, guys.